So right now, big conversation, credit cards.
Yeah.
Now, big political conversation, credit card interest rates. And, I mean, it's shaking things up a little bit.
Oh, yeah.
Right?
It is.
Some, what is it? Threats going back and forth. But it's interesting because it poses a lot of questions. I think, I don't know how you felt when you first heard it, but when I first read the post, and actually, you know what, for those, I'm sure everybody's seen it by now, but basically Donald Trump puts this post and statement out, right? That's basically, please be informed that we will no longer let the American public be ripped off by credit card companies that are charging interest rates of 20 to 30% and even more, which festered unimpeded during the sleepy Joe Biden administration. Affordability, all caps, exclamation point. Okay? And then he says he's calling for a 1-year cap on credit card interest rates of 10%. Coincidentally, the January 20th date will coincide with the 1-year anniversary of the historical and very successful Trump administration. Make America great again. So,
That's powerful. That is a powerful statement right there.
I feel like with most, like, consumers, even myself, like, at first take, you're like, boy, that would be nice.
10% cap, right?
Yeah, I mean, why not? You know, it sounds good, but it's like, is it good? You know, is it, who really has the controls here?
Yeah.
You know, who has more levers to pull? Who has greater, cards in the deck, if you will, to play? And who actually can win in this scenario?
Yeah, it's you're right. It sounds great, right? 10% cap on interest rates, especially nowadays where credit card interest rates are somewhere between 20 and 30%. Some of them are even higher if you look at those store credit cards, like your whatever, Academy Sports, Bass Pro Shop, whatever it is, like those kind of cards, those interest rates can be into 30%, like 30, 31, 32%. So when you say that, you're like, all right, 10%, that sounds good, right? But with any move, I'd say there's two sides to the coin, right? Who does this favor and who doesn't disfavor? And I would say that those who are drowning, and we'll talk about this later, about how much credit cards are making, or how much Americans are paying in late fees and interest rates, right? Yeah. It's astronomical when you hear these numbers. So those that may be drowning in credit card debt, and they say to themselves, I can't get over the hump because these minimum payments that I'm making aren't doing anything, right? But then the credit card companies may look at it and say, well, that 20, 25, 30% interest rates, well, that's how we make our money. And if you're going to cap us at 10%, we're in the business of making money. We're not a charity. So we've got to make our money some way, shape, form, or another. And if we're going to be capped at 10%, well, we've got to figure out the algorithm. We got to figure out the math and how we
to
win.
make it work.
Yeah.
Yeah, and it makes you, like, I've always wondered why, we've been in such a, wild changing interest rate environment for the last several years, right? I mean, we went from extremely low interest rates, extremely low, if any, inflation for quite some time, to all of a sudden this, massive increase of inflation, massive increase of, subsidized, injection of cash flow from the Federal Reserve. And then, of course, we have, increase in interest rates. And then now we're kind of on the tailwind of that, kind of pulling ourselves back down. A lot of effort, put in place by Trump and the Trump administration. Okay, so with all that said, why is it that, and I'm not saying I don't even know if you have the answer, just a thought. Why is it that banks and other lending organizations typically flow with the interest rate world? But credit card companies don't. So like when I think about, right now, getting a mortgage. I mean, if we go look online and we look at the average mortgage rate for a 30-year mortgage, or we look at lending a vehicle, for the next 5 years, 6 years, whatever it may be, the truth is you're going to see a lot of different options, a lot of different vendors in lending institutions, and they're all going to be fairly competitive, right? Why is it that their rates are adjusting with the interest rate environment that we're living in, but it seems like credit card companies can just do their own thing, Interest rates are much lower now, yet they're still charging 20, 22, 24, 25%.
Yeah.
It's a good question to ask.
It's a good question to ask, and I don't know the answer to that. And maybe that's why, if you read that post again that Trump put out, he calls it a ripoff or a scam, or Americans are being scammed by this. And maybe no one in power has tried to challenge the status quo, right? Challenge these large institutions, your American Express, your MasterCard, your Visa, your whoever, Discover, all these different credit card companies, right? These behemoths. And no one, at least I'd say this, no one has seemed to buck that system. And finally, there's someone who's saying, well, enough is enough. The question is, does he have the power to say enough? Well, he can say enough is enough, but does he have the power to execute that his request? And, he says
that's a good question.
And he
right?
says effective January 20th. And when was that post put out?
Yeah,
What
it was
date
like the January 9th, I think.
Okay,
is
so
when he did it.
he's giving 11 days
Yeah.
for these institutions to say,
Rewrite your business plan for 26. I know you might have had one, but it's gone now. Yeah, that's a pretty tight deadline.
Yeah.
Okay, number one, but to your point, is it even a deadline that can be enforced? I mean, that's been a lot of the rhetoric post the statement is like, does he even have the ability to do this? Like, what statute actually, corresponds with a law that allows the president to enforce some type of cap? And then, you kind of go to like a free economy, or for which, whatever. I think there's probably some discrepancies anyway, but we believe anyway that we live in a free market. Mm-hmm. Is it right to do that? And then ultimately, what can happen? What can these companies do in exchange? And it goes back to the statement earlier, like, who has the bigger hand here? Mm-hmm. We know one thing for sure. Banking institutions, they're known for their ability to manage and control risk. So if they are forced to do something on one side, my natural thought process would be that all they're going to do is reassess and reallocate risk within their model to keep revenue and margins the same.
Yeah.
Okay. And I think that's probably possible. So putting a cap at 10 sounds great, but what do they do as a pivot point, and how do they control the margins? Because they can. They have several levers to control. And so I want to jump into that. All right. So let's talk about how these credit card companies make money. I think it's a good question that a lot of people have, and it's just, man, how do they do it? It seems like at first take, I hate credit card companies. They charge a ton of interest. They're ripping America's off. I believe in this. That seems to be like the thought. How do they make money?
Mm-hmm. You're asking me how they make money. I thought you were going to break that. Well, they make money, first and foremost. One way they make money is by the actual interest rates themselves. Yeah. Right? So the 25, 30% interest rate, well, part of that is how they make money, right? Part of that interest rate fee is to pay for servicing, processing, the risk, staff, and everything of that sort. So that's part of how they make money. Another way they make money is by late fees, right? And that's another way these credit card companies make their money is, offering late, assessing late fees on balances that aren't paid off. So that is another way that this can impact them, right? Because again, you cap their 10%. Now you're capping their income for the most part, right? And their profit.
And the question is like, is it profit that they have to have? So listen to this stat right here. U.S. merchants paid $187 billion in processing fees in 2024. Are you freaking kidding me?
How much?
Okay, $187 billion in processing fees.
That's
processing
insane.
Fees. All right, I got to go way back here. Okay, I got to go way back.
Oh yeah, I know where you're going. I know exactly where you're going.
All right, a man that wore a lot of hats as a young, trying to survive guy. That was me, right? There was, let's see, it was 6 weeks. No. Yeah, like 6 weeks before we get married, okay? Mm-hmm. We're talking back in 2020. Oh my gosh, I hope my wife's not listening to the show.
You better remember your anniversary.
That's terrible, 2007. Okay. So we're about to get married. We're like 4, 5, 6 weeks out. I lose my job, all right? I'm running heavy equipment, grading for chicken houses. Okay, there actually is a good point to this, so hang with me. 4 chicken houses out in Fairmount, Georgia, and I'm doing the grading, whatever, because that's what I did. After school, I started running heavy equipment. All right. Well, as you well know, 2007, things are tightening up. Banks are lending less. We got a financial crisis, whatever. So I'm like the only guy that this farmer is paying to do this work. I'm out, right? Mm-hmm. So, and totally don't blame him, right? He's got a big family and he's trying to survive too, and everybody's doing their best, right, to keep their head afloat. So he kindly says, hey, I'm going to try to help you out as much as I can, but the truth is I can't afford to keep you. The bank's not lending, and I'm going to struggle with getting these houses complete. Okay, so I'm out, and then my wife loses her job. Okay, so she is working at a gym, at getting there like at crazy times in the morning, helping open a gym that is no longer here in town. And same situation, everything's tightening up. People are starting to lose jobs. We're right at the brink of 2008. And so I'm scrambling. All right. My brother-in-law at that time says, hey, I got maybe an opportunity for you. There's a friend of mine that's in the credit card business. And so this is how it gets all leaked in here. Mm-hmm. He says, you can go meet with him and see if you could sell credit card machines. Okay, so I sold credit card machines. Mm-hmm. Okay, actually, I tried to sell credit card machines, and what I didn't realize at that time is this statistic right here: 187 billion in processing fees. That's kind of like the silent revenue stream that I feel like people forget about. Like when I started looking at like selling these machines, it only lasted before I actually got a job. Elsewhere, it didn't last very long for me, and I wasn't great at it. But when you realize that these organizations like restaurants and retail shops or whatever, right? I mean, the cost that's going out the door because of these things, like as a consumer, you kind of forget about it. You just, beep, done. It's a lot of money.
Yeah, it is. It is. I mean, I know those who've, you can see at the checkout that some of them are passing that fee to the consumer, right? When I donate to our church Crosspoint, it asks, do you want to accept the credit card fee? Mm-hmm. And obviously I say yes to it, right? But that's a processing fee that, that's happening. That's just me doing it on a weekly basis in a church that has 5,000 people, 3,000 people. Every week, that little check goes out. Now you're talking about a society, a consumer society, where for the most part everyone has some form of a credit card, right? And those fees, $187 billion.
That was 2024. That's crazy.
Right.
Listen to this one: late fees, average of $14 billion in revenue annually. Late fees. 14 billion. So that means Americans are spending 14 billion and not even addressing the debt or the interest, just late fees.
Yeah, so you're asking who wins in this? Who wins in the credit card scheme? It's credit card companies. At least from right now, you're giving out debt to people to the tune of $14 billion in late fees to basically a pool of people that are struggling to pay the minimum balance in a timely fashion. So they're to the tune of $14 billion. Yeah. That's insane.
So the question though is like, I mean, and I'm just like playing devil's advocate here. Is it the credit card gets this money, right? This revenue. Obviously, they have operational costs, right? We know that, right? They have, I'm assuming, significant costs for compliance and cybersecurity and stuff like that. I could only imagine, right? Because there's a lot of fraud out there, and so they have to really probably spend a lot of money on protecting their product and their service. You have these credit cards that have these massive reward programs, right? So a lot of that revenue is like re-incentivizing. And this was actually brought up to me by a client a while back, and now I don't know if I fully understood it, and I think I understand it now just talking about it. They're taking interest, okay, these companies, interest from people that probably are struggling to pay off the debt. This is consumer debt that's rolling over month to month. Mm-hmm. They're taking the credit card companies, the interest from people that can't pay it off, buying rewards for likely the people that are paying it off every month. That almost seems, I like my rewards, but I feel like that's a little conflicting. Am I right there? I mean, does that seem a little, because that's what's happening. I mean, the reward programs are provided from the revenue of the interest and the late fees and all this stuff, right? So are we as individuals, I don't want to go there with the conversation because I'm not sure I want to actually address it personally, but that's an interesting question to ask. I mean, point is when we go into this playbook, like what's the cards at the hands of the credit card company? Well, those could be one of them, like the whole point system and stuff like that, you know?
Yeah, and also another way credit card companies make money is by their annual fees for just to have the card, right? So as because our audience are high income earners, high net worth individuals, our clients for that. And so some of them may say to themselves, okay, 10% cap, what does that mean? What does that mean for me, right? I'm one of the ones who is rewarded because I pay off my balance every single month. I'm not rolling anything over. So boo-hoo for those who are part of this $114 billion late fee. That's not me. So why does this matter to me? Well, why it may matter is because while you understand when you said who controls the levers, well, we as consumers don't control the levers of annual fees. So all of a sudden I have this reward card that's costing $95, $100 a year, $500 a year to have, right? Like an American Express card, it's probably your high-end American Express card is probably $500 a year to have. And you're like, oh, okay, no big deal. I make $400,000. What's $500? Well, if this happens, this 10% cap, you may wake up the next morning and see, oh, your credit card annual fee is $2,000. Yeah. Now you may say to yourself, whoa, wait a minute. Why am I getting impacted by that? Well, I've got to as a credit card company, I got to make money somewhere. You refuse to play our game by rolling your debt over every single month. You refuse to play our game by you having a balance so I can get my $14 billion. So we're going to reward you by being a great consumer by just charging you $2,000 to have your card.
Yeah. Yeah.
That's the way someone can be impacted.
So level one, companies say, we're not taking the full burden of this.
Yeah.
We increase annual fees. What are other levers that you think they're tempted to it? Like, what's their backup plan? They got one for sure. You and I both know that.
I think another one of their backup plans, because you said they're in the business of risk. So I think you said something like that, right?
Yeah. I think they're experts at reorganizing risk in a way to always create and support healthy margins, for sure.
So another way they can reorganize risk is, any type of loan has a risk involved in it one way or shape, form, or another, which is why your credit score is very important. Now, it may be a manufactured score, but at the end of the day, there is relevance behind your score. Mm-hmm. So right now, I believe it's like 80 to 85%, something like that, of those who have credit cards have a FICO score of, I think, of less than 720, right? So another lever that they can manage is, well, we're just going to reduce your limits to your card. And so you may have a $50,000 credit line. And as a small business owner, you run your business off that credit card. Now, I'm not saying you're carrying a balance of $50,000 every single month, but you're buying new equipment, you're buying, whatever it is, products, inventory, whatever, using your credit card, and you're running your business off a $50,000 limit. Well, one lever they can say is, well, we got to adjust our risk. So we're going to bring down your limit to $30,000. Mm-hmm. Well, that's a big deal.
Yeah, it's a big deal.
That's a big deal, right? Because if you have other credit, your debt to income ratio, your credit utilization is based off of how much balance you have in relationship to the limit that you have on your card. So if you have a $50,000 balance, I'm sorry, $50,000 credit limit with a $10,000 balance, that's a 20% utilization, which is good. You want to keep it under 30. But if all of a sudden they cut your limit from $50,000 to $25,000 and you're carrying a 10,000, well, that's what, a 55% utilization? That's awful.
Yeah.
That's
Yeah.
awful.
But
With respect to your credit
but
score.
I feel like there's two sides to that coin, because for business owners, your point's right. I mean, if they have these credit card companies are going to do something, one decision would be to basically reassess who now is their prime borrowers, right? Or maybe an alternative move would be reducing the credit card limitations on all, right? And then maybe selectively saying, okay, we're just not even we're shutting your credit card down, right? So all those are actually very real, I think, items that should be considered. But I think there's like a positive side to that, I feel like, in some aspects, which is, there's a lot of individuals and a lot of Americans, clearly by the statistics, that can't manage credit cards, that have credit cards that they shouldn't have, that have debt on credit cards that they shouldn't have, right? So, it's kind of like some forced assistance there, I think, in some sense, right? That, hey, if your credit card gets shut off tomorrow, this feels like a very strong negative experience, but it could be the one thing that actually creates very healthy financial stability and discipline for the rest of your life, right? Because clearly, $180-something billion,
14 billion
in late fees. Like, clearly there's a lot of people that have made very poor financial decisions. And so, yes, the truth is I think this message from the credit card companies that, hey, we're just going to restructure risk, and what's going to happen is, and they make it sound like a big negative, what's going to happen is we're not going to be able to provide credit for all the people that are used to and comfortable with us providing credit, because we can't control and manage that type of risk. Well, it sounds like a negative. I think the question is why did you provide credit to those individuals in the first place? Not because you felt like don't sell this to me like you're helping them out. You didn't help them out. You created $14 billion in late fees, revenue for your company. That's what you did. No, you should have never lended it to them in the beginning. And so...
Sounds like the very familiar to the housing crisis in 2008.
100%.
Right? Why? Because you were lending out loans. I remember, really quick, I remember I was a freshman in college, and I went to open up my first adult bank account, right? I figured, I'm in college, I'm 18 years old, I should do something like as an adult. So as an adult, I'm going to open up my own bank account, nothing that's associated with my mother, my bank account. So I go to, and I hope I can say their names. I don't think they're even in business anymore. Washington Mutual Bank. Open up my credit card. Open up my bank account. The banker, the teller says, "Oh, by the way, 18 years old, you've been approved, not pre-approved. Somehow I got approved for a $250,000 mortgage."
There you go.
I called my sister. I remember walking away and I was like, well, I'm living on the dorm. Like, I don't need a mortgage.
Yeah. Gotta have.
Yeah. But I called my sister and I was like, hey, I just got approved for a $250,000 mortgage. What if I bought a condo? And I can do this. And she was like, you have no money. You don't have a job. Like, you're 18. And I was like, but the bank said I've been approved. And she's like, you have no money. And I was like, okay, I get it. Yeah. Point. And the conversation got shut down. But during that time, there were people that were approved for loans that the bank knew darn well that they do not qualify. They're going to get foreclosed on. They're going to be paying late fees and all this stuff. And we found a profit engine.
And I personally feel that that's exactly what's happening here. I mean, they literally lend to those that should never receive the credit limit that they receive. They then know that those individuals are going to have to spend most of their money paying only interest and late fees. Then they use good creditors or good borrowers to extend the credit line to help cover the risk because they have the ability to cover whatever debt they have, right? And even though they may be paying interest, but they use this to cover the risk of the default of the individual that may not pay it. I feel the concept of the game is lend to those that can't afford to be lended to, okay? Trade the risk off with your prime lenders, ride the fees as long as possible, readjusting, massaging. Okay, we can do this. We can do consolidation. We can reduce the rate, or we can remove the rate for the month of December because it's the holiday. Do whatever you can to massage it to extend the life expectancy of the payment plan by the consumer that you know is defaulting at the end of the day.
Yeah.
Anyway.
And guess what they do? As you say that, you said you changed the math a little bit on that side. They dangle this balance transfer.
Right.
Oh, all the time. You can't pay your $25,000 balance. Guess what? We've got this enticing offer, 0% for 18 months. Just we'll help you. We'll rescue you. You bring that balance over to us. We'll charge you 0% interest. Right? Knowing darn well in 18 months you're not paying off that credit, that balance, and then rinse and repeat. You're back on that cycle again.
So we're talking credit score already drives availability, pricing, risk. Now we compress the pricing rights of the company to cap at 10%. For sure, hands down, the lending becomes much more selective, okay? Becomes much more compressed. And I don't necessarily feel, I could be wrong for sure, but I don't feel like that's a full negative play and counter by that organization. There's some benefit though at 10%. Okay, let's play I want to throw this at you and see what you think. Okay, let's say it works. He drops at 10%. Well, our business is an example. Well, we pay the credit card off every month, right? And not that 10% is like an attractive rate today, but it's like I wonder if that motivates any business to maybe leverage a little bit more, to invest a little bit more, to put more money back in their developmental phase of their business, research and development and product or whatever. I wonder if even it becomes a little bit competitive with banks. Like if now, because they're controlling the rate, I wonder how close they get to compete with like a small business loan or SBA loan or a direct loan with the bank.
Yeah, I didn't think about that, but that makes sense, right? I mean, like if you're looking to, again, credit cards you're borrowing money, right? Well, if you're trying to invest in your business, right? There's this opportunity you want to involve yourself and involve your business in this product, this whatever it is that can really inject a good system into our business. But you know what? At 25%, I don't know if I can do that. But at 10, but it's capped at 10.
Right.
So you have good credit, it could be 8. And you say to yourself, "Whoa, 8%? That's kind of attractive in today's climate when a 30-year mortgage is like 6." So at 8, yeah, that seems pretty interesting, right? Yeah. I can buy that equipment. I can hire that new person, right? And 8%, yeah, I don't want to keep this 8% for that long, but if I can invest in something that I know can really make a great impact in my business revenue, and then I can pay that off in 6 months because whatever I invested in actually paid off. Yeah. And I don't have to it's there.
I mean the question is like, would you pay your debt off faster at 10%, or would you be, would it support like your mental concept of maybe delaying it a little bit more, And I think you're right. I mean, I think the one urgency like I would throw out there is like cheap debt really doesn't delay urgency. Okay. It's still debt, even though it's cheap. I think the risk is not removed. You just have to be more practical and mindful, of how you address it. Like, maybe I just look at debt differently. I think debt is a tool. For some people, I get it. Like, life happens and you need a backup plan now. Okay. But the goal to be successful financial stewards over time, the type of client that we typically work with, they're using debt as a tool, and so at 10% or less, I think it becomes maybe an option in the toolbox. You know,
I think it's something to think about, right? I mean, that's why when you one thing I could say that will help people either get successful financially or continue to be successful financially is having a plan around your finances, right? And when you have a plan, you can look at opportunities in front of you and weigh out whether this is a good opportunity or not. Right. And part of the value add that we bring to our clients that I think other advisors don't do is that our clients come to us with opportunities that are presented to them. And then we look at it in relationship to their plan and let them know, remember, was it last year, maybe a year ago, we had a client that was asked that from Alabama that was considering buying a new business.
Yeah, right.
And we assessed the entire situation and said, you know what, if you did this and did that, this could actually be a good opportunity for you. Right. Some of it did involve a little bit of leverage, a little bit of debt, but we had a plan of how this actually, if you did take on this debt, how this actually impacts your long-term plan. And if you do take on this debt, we have an action plan to pay it off. Like we have a game plan of paying it off. So I think, like every opportunity is two sides to the coin. One person may say, my gosh, 10%, like this is great. My interest has been cut in half, right? If I have $25,000 balance at a 20 some odd interest rate, I think your minimum interest payment is like $400, $450. Right. At 10%, it cuts down to like $250.
Yeah, don't go increase it.
Don't go increase it, right? But use that extra money to pay it off faster, and then you have those that really look at it as an opportunity.
Yeah, and I think that's maybe the closing piece here is that this regardless of like which direction this goes, a cap of 10%. For the majority of our clients who let's say are at a place of financial freedom, right? They're constantly looking. If they're still in the investment game, right? These are our guys that are, number one, they're high income earners. They're still out there in the hunt. They're looking for opportunity, and in that case, a lower, more competitive rate among all credit card companies is a good thing. It's more than just leverage. It's liquidity. It's a bridge, for deal making. No longer do you need to go, do a private loan or a private lending agreement to go knock out this offer and this deal. Okay, we have credit cards at a rate that's now competitive. Let's do it. Right? That's the mindset. It's a tool for those that have revolving debt for things that are everyday life expenses. You got to get that out. You got to get it out of the way. Mm-hmm. Okay. Don't look at this reduction in interest as a leverage tool to extend the loan. That's not the case for you. This 10% reduction is a gift for you to accelerate the payoff of all of the revolving debt that's going toward life costs that aren't actually investment opportunities, in my opinion. You got to get them off. Okay, to the point where it's not revolving month to month, and I think that's just good fundamental guidance. You should not, and I get it, things happen. That's why I say use this as an opportunity. You don't want to go, to Walmart or to Publix or to Kroger and go, spend $200 in groceries, and it takes you a month and a half, 2 months to pay it off, and now the bread that you bought already inflated cost you this much more. That's silly, right? So I think for those that are in debt, revolving debt, this is a benefit. Get it paid off. For those that are like many of our clients, investors out there hunting the opportunity, this is more liquidity. Consider it as an option and a tool. Let's keep rocking.
Let's keep rocking.
If you have points on a credit card like me, be very cautious. Maybe spend them. I feel like that's like, hey, I'm on Bass Pro Shop right now. I'm about to wipe them out. I'm like, you ain't taking my points. I got it.
Yeah, that trip you've been delaying, go take it.
Oh, yeah.
Use those freaking fly miles.
You may want to use them. Yeah, who knows? He says, hey, government forced us. No cap. We say, hey, no points. I'm like, nope, I'm getting mine. That's concerning.
It is. And, like anything else, right? Again, this is not enforced. This is not a law now. But if you read the tea leaves, right, this is something that is taking up a lot of storm. And like any good steward, be mindful. Use this, like you said, use this as a gift, right? If you don't have a plan, get one. Give us a call, right? I mean, I don't want to make this a shameless plug, but honestly, we are very passionate about what we do, and we are here to help. So if you're saying to yourself, this is all good stuff, how can I personally use this as a gift? How can I honestly take advantage of what is being proposed and what might likely happen, and I don't know where to start? You have a place to start. Like, subscribe, share, but give us a call, shoot us an email, go to our website, and we are here to help.
Absolutely. Well said, Mo.
All right.
And for everybody in the general public, I think I end with this. If your plan depends on revolving debt, it's not a plan. It's just exposure. Take the time to get wise. See you next week.